Katie Roof, the tech deals reporter for Bloomberg News in San Francisco. I'm joined by Roger Premo, who is, well, they're not sitting in the order of my sheet, but Roger Premo is over there. He's the general manager of corporate development strategy for IBM. Next to him is Jeff Thomas, senior vice president of Nasdaq. Michael Brown here, partner at Fenwick, and then Amy Olah, managing director, CIBC Innovation Banking. And we will be talking about the changing environment for liquidity. So yeah, it's definitely been a changing environment. I mean, my job last year involved me writing about a lot of IPOs, and that's not happening right now, but some other stuff, some M&A and what have you. But I'm wondering, in terms of market correction, have we hit rock bottom? Or is the market going to go down further, or do we think we're here at the bottom? Does anyone have any opinions on that?
So our chief economist does a lot of work around looking at federal funds rate versus price to earnings ratio for the broader market. That's assuming your company has earnings. And so if you look at the S&P 500, which is an index that tracks only profitable companies, you can actually see a nice correlated line between federal funds rate and the PE ratio. And I think we've right now got the next two rate hikes priced into the current PE of the market. So then it really becomes what happens after that. Does inflation continue to drive up and then the Fed has to do more aggressive movement? Or do we start to see an economic slowdown and therefore they maybe loosen up, maybe by reducing some of the quantitative easing that they've said they're going to tighten? So I think, you could argue if it's going to be a soft landing, we're pretty close to the bottom with Nasdaq off 30%, S&P down around 20, and Dow down around 10. But I think it really comes down to what happens this summer. And then, of course, there's the global macro questions around Russia, Ukraine, the continuation of COVID and lockdowns. And so those are all the exogenous uncertainties that are hard to plan for.
Yeah, and so I guess with you're looking at IPOs and when that will reopen. I guess it will depend on what happens this summer and whether or not we'll see IPOs this fall. There haven't been any.
So we always love to say we have solutions for every stage of a company's life cycle. So we have Nasdaq Private Market to help companies provide liquidity before they go public. We love to take companies public, and then we have a suite of investor relations and ESG offerings to help people be better public companies. And while in the tech sector we haven't seen any new listings, there's been one tech IPO this year, we've had 120 new listings on Nasdaq already this year. And that's across SPAC IPOs, IPOs from other sectors like financials, energy, healthcare, and then SPAC business combinations. We've actually had 20 of those continue on, and there have actually been some tech names in that spot like Inspirato, Sonder, SoundHound. So while the death of the IPO market has been widely reported, and I agree there's not been a lot of tech IPOs, there are still new companies coming to market. And we certainly hope we see the window for tech IPOs open up this fall once we kind of get through that macro adjustment.
Well, and I think there are a number of tech companies that are continuing to get public company ready. So right now the window is not open for actually consummating an offering or a direct listing, but companies are still getting ready so that when the proverbial window opens, they'll be ready to go. And so taking steps, confidentially filing, submitting their S1, ensuring that they have a board that is public company ready, taking the other steps necessary. And there is a big backlog of companies because, as noted, there's only been one tech offering so far this year. And so you have companies that are getting ready, submitting their S1, so that when the banks say the window is open, I think you will see a large number of companies that are ready to try and hit that window. Now, when it opens, that's if I knew that, I wouldn't be an attorney. But I think there are companies that are getting ready. I think right now they're queuing up, hoping that the window's open in September. I think companies have kind of given up on the June possibility. But there is still hope that later this year the window will open, and there's a large number of companies that plan to be ready if that happens.
So, when you say large number of companies, are we talking last year's number of companies or I guess I'm just trying to get a sense of a few big companies, or is it a really big crew of pre-IPO companies that think they can go public?
I think it would be difficult for anything to match last year. It was certainly a bellwether for the tech industry with a number of extraordinarily high-profile companies that went public, Coinbase and Compass and GitLab and SentinelOne and many other high-profile companies. So I think it would be hard to achieve the success that the tech industry had last year with companies that went public. But I do think that there are both a large number in depth as well as some high-profile companies that are hopefully that are getting public company ready.
One thing we track internally at Nasdaq is the number of pending listing applications. So that's when you apply to list on Nasdaq, it's different than the S1. And we actually see pending listing applications right now, year to date, are up 30% over last year because you're building up this backlog of companies that are kind of waiting and trying to get ready. And then I think one of the big questions is, which companies will the bankers lead with? Are they going to lead with kind of high growth assets, or are they going to look at companies with more free cash flow, or probably something in the middle?
Yeah, Amy, I'm wondering, you help companies raise debt instead of equity, and I'm just wondering if with valuations kind of getting out of control last year, if that's looking like a more attractive option, especially if they can't realistically IPO anytime soon at the valuation they last raised at. Are you seeing an uptick in debt financings?
Yeah, I'm predicting we'll get a little bit busier over the next year or longer. And so there's certainly a lot of thoughtfulness around runway right now and what a company might be sitting on and where they thought they might be raising in the next 12 months. There's the consideration that that might not happen. And so what we try to do is work with both companies and investors to layer on debt efficiently to kind of get them through this market shift and possible recession that we're contemplating. I think the important thing is to contemplate it and to adjust accordingly and maybe consider a new budget. Some investors like to see more than one. They might want 3 scenarios. Some ask for 2. I ask for just give me an updated line of sight on what could possibly happen with a kind of bear-like budget. So that we can figure out how to handhold our portfolio companies and how to help investors and entrepreneurs with a new round in the next little while.
And so are a lot of them, also doing this in conjunction with an equity round where they're raising equity and debt together?
Yep. So often we'll piggyback on a lot of equity rounds. Sometimes there is no equity round, but there's a fair amount. I try to see that there's 6 to 12 months of runway so that I can layer on another 12 to 18 months of runway to get them through the next 24 months. That's probably where you see the adjustment, where in good times, I might not be thinking solely of I need to layer on 18 months of runway right now or 24 months of runway, but the mind has certainly shifted to how can we get them through to a place where valuations may normalize so that they don't have to do a down round or a flat round and get them to a place of being pre-IPO or raising their next VC/PE round.
And Roger, from IBM's vantage point, is now a good time to invest or buy companies if things are less expensive?
It's certainly an interesting time, right? We see prices lower, and I think if you look at just Broadcom, VMware, if the rumors are accurate about that, I think we're seeing.
They are. Bloomberg broke that story. We have solid sourcing.
Good. But the transaction price, so a depressed price plus an acquisition premium is kind of coming out in the zone of the 52-week high of the company. So I think if you start having some precedent transactions where we can establish what is the market price that leadership teams will accept in this market, it allows us to do planning that we can start looking at what is our inorganic portfolio with that type of precedent transaction. So absolutely, we think of, from our vantage point, this is a time of strength and a time of opportunity for us to do things that may have been outside our strike zone previously.
Yeah, so what kinds of companies are you looking to invest in or acquire?
I'll just say that for our business, we acquired Red Hat a number of years ago. That was all around pivoting kind of the new IBM to a hybrid cloud strategy. So we're investing around hybrid cloud, artificial intelligence, process automation, security around that. So those are the categories we're interested in, and that's probably, that's all public information, so that's probably as far as I could take it there.
Yeah, so Jeff, I mean, a few years ago, I used to hear a lot about dual tracking, and then everyone went public. But now I'm imagining maybe the bird in hand looks a little more attractive if, a company gets an offer. Are we going to see more like maybe app dynamic situations where they're bought right before they were going to go public? Or, I mean, maybe not that close to the IPO, but are we going to see more companies that are filing an S1 and then they end up getting bought?
Absolutely. I think with the valuations we saw last year, there were a lot of companies that just said, we need to go now and hit the window when we can. I think this year with valuations much more uncertain, I think you're going to see a big increase in dual track processes where companies are going to file the S1, maybe with the intention to get Roger to start looking at them a little bit more seriously. And so I do think we'll see a number of scenarios play out where companies are going to run that dual track process and use the IPO to kind of initiate that acquisition process.
And you probably see that as well. I mean, maybe all these filings that you're spending all this much time on end up being all for naught. But are you finding that some of these companies are kind of looking at both options right now, an IPO or a sale?
Yeah, I think a lot of tech companies right now are battening down the hatches and thinking about extending runway. Right, the last month or so of board meetings, right, that's been the prevailing theme from boards of directors to management teams, which is looking hard at your expenses and thinking about how to lengthen runway so that you're not having to go into market to do a fundraising in uncertain economic times. Maybe some of that is exploring debt opportunities, or possibly thinking about strategic alternatives if that's a potential possibility, as well as the companies that are getting ready to go public. So I think while capital markets transactions have certainly slowed with the one this year, I think the other types of structuring continue to proceed, certainly with valuations compressing and the uncertain market, the volatility, I think makes it hard right now for investors to price companies, which is difficult. If we hit bottom and it stops moving so much, there's less volatility, I think that will allow for pricing to resume. But right now, I think companies are really exploring all options. So maybe that's M&A, maybe that's exploring a debt, maybe that is exploring venture capital, private company financing, which continue to proceed. There are certainly less of them from last year, and valuations have compressed, and some of the structure around terms that we haven't seen for the last decade have come back into vogue in some respects, but there's still a ton of activity in the tech ecosystem right now.
You mentioned trimming expenses. I mean, we've seen a lot of layoffs all of a sudden at startups. Where are companies cutting back?
Yeah, I think every board meeting right now, I think there is at least one director that is saying, have we considered it? Even for good companies, even for slim companies. I think directors feel like it's their fiduciary duty right now to ask that tough question. Even if a company is doing extraordinarily well, and the answer is no, at least thinking about it, at least having the conversation about it. So I think all companies are having that thoughtful conversation. Companies may not be undertaking RIFs, but maybe they're slowing down on hiring. For the last few years, every board meeting I went to, the topic du jour was, we can't hire fast enough, right? We're off our hiring plan. It's brutal out there competing with public companies that are offering RSUs or other late-stage private companies. And so everyone was focused on hire, because you couldn't do it fast enough. Now I think the pendulum has shifted, and it's, well, should we continue that pace of hiring? Do we need to lay people off, even if the answer to that is no? Should we slow down hiring? There are certainly some companies that have said, the wind is at our back, even in these uncertain times. Let's continue to do so. But I think companies are being more thoughtful about it in the current environment.
I'll just add, I think a good place to start is just to find maybe some of the inefficiencies that exist in the budget, or are, if you're like you talk about this kind of rash hiring that's been going on the last couple of years, maybe you pause for a moment and slow down your hiring, or maybe certain people that leave your business aren't necessarily worth the money to replace right away, because you want to put that money elsewhere, or maybe your sales and marketing budget advertising and stuff that's a little bit out there can kind of swing back, and you can be a little bit more conservative and thoughtful about where that is. And then there's the bigger, this is what I was talking about, this sometimes there's more than one bear budget. It's kind of, you have a couple of budgets lined up for the worst circumstances, and as you notice growth slowing, you can make the adjustments accordingly, is the best kind of plan of action, I would think.
So, Amy, how much has the valuation correction trickled down to the earliest stages? I think you mentioned you do things as early as like Series A. Obviously, the growth stage startups are feeling, valuation correction based on what happened in the public markets. But has it really hit Series A hard yet?
Yeah, I'm still seeing a ton of deals getting done right now. That hasn't gone away. The valuation reduction in the public markets by like more than 50%, it's probably more than that right now, has certainly trickled down, and you're seeing a shift of power move from the entrepreneur. Perhaps this pendulum is swinging a bit back to the investor. And in some cases, maybe rightfully so, things are getting very frothy, and valuations were getting not making sense to me in some cases, that I'd look at a deal and sometimes not even consider what the valuation was, because it was just so high that I had to pull back and be a little bit more conservative about the way I was thinking about the debt product, because there's always a healthy amount of debt for every business. And I think what I've learned going through the dot-com crisis and the credit crisis is being conservative and thoughtful and having confidence in your forecast and amount of debt you've put on gets you through the good and bad times, and of course the bad times is even more important. So this kind of last 2 years, people were doing, my competitors, some were doing the likes of 3 times ARR, which is somewhere I won't necessarily go. And you have to decide if that's a healthy amount of debt for the business, or do you need to scale back and make sure everything's right-sized.
Can I just add, Katie, I just add one other thing, though, is from my conversations with leadership teams and founders, and as we think about ourselves as an acquirer in this market, I think there's also a human side of that. If you're a young company that's looking at a recession and you're looking at the employees you have on board, I mean, the conversations we're having is that, an acquisition may be the thing that provides some certainty of that future.
Yep.
So we think that kind of the human side of, remaining private, going public, being acquired influences some of the decision making for leadership teams. So from our perspective, we think of that's marginally positive for us because we offer a bit of that safe harbor in, some uncertain times.
Yeah, I think we talked to a lot of CFOs and CEOs about not the 10% of people maybe they're laying off, but the 90% they're keeping. So you have a huge employee base that maybe last year thought their options were worth X, and maybe now they have to reset those expectations. Maybe they thought they were going to go public in the first half of this year. That might be moved out 12, 18 months. So how do you provide interim liquidity to those employees to help retain them? Now, obviously, it's easier to retain talent in a down market, but you still want to make sure they stay motivated and excited. And so I think that's where we probably will see more companies looking at things like private tender offers to provide some interim liquidity. When we saw the last kind of minor valuation correction in beginning of 2016, that year we saw many more buybacks by companies through Nasdaq Private Market than third-party tender offers, because that puts the control into the company's hand around what price they're offering. But again, that's got to be funded somehow, so they still have to be able to go out and raise either equity or debt to fund those.
But how do you determine the right price for a tender offer in this environment? We saw Instacart, they lowered their internal valuation. Klarna is considering raising a down round. How do you get buyers and sellers on board? And there's often a big disconnect at a time like this.
I think whether you work at a public company or a private company, it's an emotional journey to level set that your stock is now worth less than it was. Nasdaq was at $210 a share last December. We're down at about $140 a share. So that's an adjustment, and employees have to kind of go through that, whether you work at a public company or a private company. And to Michael's point, the thing about public companies is the liquidity is real time, even if you don't like the price. But I think that's where private companies have to be thoughtful about when do you let employees have that opportunity, and how do you kind of message that to them so that they stay engaged.
I do think we are going to see a slowdown in liquidity events for employees because historically either the company would do it or third-party purchasers would do it. Certainly companies right now, to my prior point, are focused on conserving cash, extending runway, and so using cash to provide liquidity for employees I think is going to be backburnered as a potentially unnecessary expense when the goal is to extend runway to make sure you have enough cash to see yourself through these uncertain times before your next fundraising event. And then if there are third-party purchasers that may be interested in purchasing shares of the company's stock, I think a board of directors is going to have to think through, do we want that money going to employees or do we want that money going to the company's balance sheet? And there are lots of transactions where it's both, of course, where some's going to the balance sheet and some's being used to provide liquidity to employees. But I think that's going to be a conversation that in the last few go-go years, companies could have their cake and eat it too. And they could ensure that they could do large liquidity programs either off their balance sheet or having purchasers do it, knowing that another financing was just around the corner. But I think now there's going to have to be more thoughtful discourse on how you approach the possibility of employee liquidity.
Are you finding that a lot of companies are having trouble raising funding right now? Because I mean, the last few months we've been hearing rumors like company X wants to be worth, whatever, 20 billion, and then they come to market and it doesn't happen. And so I'm just wondering, how many of them are, coming to market and not able to get the terms they want, and now starting to panic about cash?
Well, I think that last comment you made is the right one, which is it's not about the ability to raise capital, it's about the ability to raise capital on the terms that they want. Certainly there are a lot of funding sources still available to companies, and investors aren't saying we're closed for business. I think what they're saying is we're going to do it at a thoughtful valuation and on terms that make sense, and maybe that includes some structure. So I think the issues that companies are struggling with right now is wanting to do a round, maybe it's an up round, maybe it's even just a flat round, but thinking about that contrasted with the story they've told their employees, and if it's a down round, how does that impact morale, or how does that think about the company in perception compared to competitors? So rounds are still being done. We're still seeing a lot of financing activity, private companies able to raise funding. Are the valuations as high as they were last year? No. Are we seeing additional structure type terms reappear? Yes. So I think it ultimately comes down to how badly does the company want to raise the funding, and that's why companies are seeking to extend runway, so you aren't forced into that choice of we need fundraising to survive, and so we are taking terms as opposed to helping to set the terms.
Roger, do you think we'll see more acqui-hires right now, where teams get bought to kind of avoid a shutdown, and then, big tech companies can have good engineering teams that work together?
One is yes, in general, I think it's true. I kind of talked about that safe harbor. If you're a founder and maybe you're early stage or the unit economics aren't clear for you, it may feel that, something like an acqui-hire is a much more attractive path. So again, I do think that will be something that we'll see, but I think it's going to depend on how the shape of the summer goes in terms of, and it depends on kind of the maturity cash position of the individual company. And I just like to pile on what Amy said earlier. I mean, our main, we think about the IBM business overall, and then the advice I give different companies is, it's not about forecasting what's going to happen. It's about having a set of scenarios planned and have those ready so that, as this set of events unfolds, you're ready to take advantage of how it develops. So that's how we're thinking about it for our business, and that's the advice that we're given to companies that we work with, so they're ready for what may come over the next several months.
Can you elaborate on which industries within tech you think will see the most consolidation?
I think it's more about the stage of company than a category in tech. I think you're going to see, the Broadcom VMwares, if it's ones that are large companies where there's a value creation opportunity by acquiring and then hopefully, seeing the market come back. I think you'll see things like that. I think we see categories like cybersecurity, which really haven't been impacted in this downturn because the underlying demand signal for that is, state-sponsored hackers and things like that continue to be driving that market. So I don't know that I have a categorical trend we're seeing, but it certainly is a maturity and then some subcategories that, are showing real durability like cyber.
I'll just add, during the last couple of years, we also do acquisition facilities, and we'll kind of put together a term sheet that implies how we could help an investor in the company purchase a target company. Many of those transactions have fallen apart because the valuations have gotten so out of control that they're unwilling to pay that price. So I do think if you're fortunate enough to have a bit of a padded balance sheet going into this market, there's going to be a lot of buying opportunities, and I'm probably going to see some more successful execution of that, where the last couple of years, there's been a lot of successes of acquisitions, of course, but there's been a lot of false attempts, unfortunately, to get something done.
Which tech scenes are, there's been a bit of a diaspora from Silicon Valley. We're here in LA, and I'm just curious, which tech scenes are kind of bustling right now, relatively speaking?
I think the pandemic really reinforced the fact that Silicon Valley is more of a mindset than a place. It sounds trite as I say it out loud, but I think it's true now, right? And certainly I think you have the ability to do fundraising pitches and not have to go up to Sand Hill Road and walk up and down, and everybody does it via Zoom. I talk to VCs and they say, we just want to do it via Zoom now because we can see a lot more companies. And so it has really opened up the world to great founding teams and great companies regardless of location. And you have companies that are remote first now, so there is no pure location, and they do employee offsites where everybody gets together every so often. So I guess what I would say, and welcome my colleagues here, but I think everywhere. I think we're seeing activity in locations that you might not think of as a tech hub, but founders have moved there for whatever reason, and they started a company, and they're able to get dollars and talent because of a remote first environment. And so I think that's really exciting, and I think that is long-term bullish for the tech ecosystem, that it's not you have to be in Silicon Valley or New York or Santa Monica to get funding.
Yeah, I think it's even hard to define maybe where a company's based now, right? I mean, if you're a remote first company, you're just going to say it's where the CEO lives, like he may not live where 90% of his team lives. And so I think, if you look at some of the fun things that have come out recently, Salesforce now posts jobs by time zone, not by city. So that's kind of an interesting way to do it. They're saying, hey, this is where this team exists, on a latitude. Airbnb has said, live wherever you want, right? They're kind of putting, faith in their product that people can find great places to stay anywhere. So I think that's going to be a big trend is, companies I think will just become more distributed over time.
Katie, I just add just the fact we see kind of that technology innovation being really global. And, if I look at the last, 4 or 5 software acquisitions we've done, of course the United States is headquarters for some of them, but Australia, Germany, Brazil, so we're seeing innovation globally. And we actually think from our perspective, looking globally for acquisition targets, increases the aperture of what you can find, and it's, looking that way is a strategic advantage for those that do it. So we see a lot of innovation in a lot of places.
All right, well, thank you so much. It was great to hear your thoughts.